Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're digging into the latest from Webster Financial, ticker WBS.
So, here's the big question. Webster Financial just dropped a record quarter, but the stock? It pretty much just shrugged, especially after getting hit hard the day before. We're going to unpack exactly why that happened. Okay, let's get right into it.
Okay, first up, the headline numbers. GAAP earnings per share, or EPS, landed at $1.54, and that was a really clean beat over what analysts were expecting.
And check out the revenue, $732.6 million. Not only did that crush expectations, but it's up over 13% from last year. I mean, that's some serious growth.
So you see where this is going, right? A clear beat on both the top and bottom line. So what gives? Why the quiet reaction from the market? The numbers look great, but the stock's performance is telling us a totally different story.
And it's not like management was shy about it. Their tone on the call was super confident. You had the CFO, Neil Holland, basically celebrating these record results, and you can't blame him, especially with the company hitting its 90th anniversary. It's a big milestone.
But here's the context, and it is brutal. The day before they reported, the entire regional bank sector just got slammed. We're talking a massive sell-off. So Webster got dragged down right along with everyone else. And even a fantastic report the next day just wasn't enough to fight against that wave of fear. Okay, so let's shift gears and look at the story management was telling. On the call, they were laser-focused on one thing: disciplined execution, and making sure shareholders are getting rewarded. And their core message was crystal clear. First, deliver great returns, and they did, hitting over 17.5% return on tangible common equity. That's a huge number. Second, run a tight ship with a top-tier efficiency ratio. And third, give that capital back to shareholders, buying back 2.2 million shares. The CEO, John Sila, summed it up perfectly. This consistency and excellence persists.
All right, now this is where it gets really interesting, because it's one thing to say all that, but it's another to back it up. And they did, right here on the balance sheet. Think about the environment we're in right now. Deposits are gold. Everyone's fighting for them. Yet Webster managed to grow both loans and deposits. And look how close those numbers are. They did it in almost perfect lockstep. That takes some serious discipline.
And this chart really shows you the quality of that growth. Almost 90% of their deposits are what we call core deposits. This isn't hot money that's going to run at the first sign of trouble. No, this is the sticky, stable stuff. And that right there is a massive advantage.
Now look, they're not totally immune to what's happening in the industry. You see their net interest margin, or NIM, which is just a fancy way of saying the profit they make between what they pay for deposits and earn on loans. It did get squeezed a little bit. But, and this is a huge but, look at their credit discipline. Net charge-offs are super low, and even more important, those criticized loans, which are like an early warning system for trouble ahead, they actually went down. That tells you the loan portfolio is really healthy.
So this brings us right back to the central puzzle. The fundamentals look this good, so what is the market so worried about?
And here's the disconnect, plain and simple. On one hand, you have management talking about record earnings and a 90-year history of stability. On the other, you have a market that is just consumed by fear about the entire regional banking sector. So really, the market wasn't trading Webster's amazing quarter. It was trading fear. Webster is a great house, but right now, the market thinks it's in a really bad neighborhood.
Okay, so for this last part, let's talk about what we're calling the next call. This is our take on what's coming and where the opportunity might be.
So straight up, we're rating the stock outperform. Why? Because we think sooner or later, the market has to wake up and reward this kind of execution. We're predicting the story for next quarter will be pretty much the same. Rock-solid credit, more capital returns, and that should eventually be the catalyst that lets the stock price catch up to its fundamentals as all this sector fear starts to fade.
Our core thesis is really simple. The market is punishing Webster for its zip code, not its performance. It's a classic case of guilt by association. And that sets up a classic investment play, right? You want to try and isolate this high-quality company from the general weakness of its sector. The goal is to capture the alpha, or the extra return you get from Webster's stellar execution, while protecting yourself from the beta, which is just the general risk of the whole banking sector dragging you down.
So here's the idea, a pairs trade. You go long on Webster, WBS, because you believe in the company's fundamentals and think it's mispriced. But at the same time, you short the regional bank ETF, KRE. Why? Because that acts as a hedge.
It helps protect you from those big, sector-wide headwinds that are probably going to keep hitting the weaker banks. This trade is designed to isolate and capture Webster's relative outperformance.
And as always, we have to close with this reminder. This is not financial advice.